Okay, good afternoon, everyone. As introduced said, I am head dealer at Reyker. I've been with Reyker for about 15 years now, and we are specialists in essentially in global investing. We invest in many different markets around the world. We have a strong presence in the UK. From a discretionary fund, we look at a lot of investments in the US and in Asia as well. Now, the purpose of my presentation today is to echo what I'm sure you've heard a number of times today about diversification and how it's important to all of us as investors to look at the investing in single stock equities against, in some instances, investing in broad market-based investors, like the last speaker said about ETFs. And finally, to introduce a investment concept, which some of you may or may not have heard of, which I believe and we believe is an interesting concept for picking investments for the longer term. So first of all, in respect of diversification, probably the primary concern for most investors is to know what your long-term objectives are. Think about what you're looking to achieve from your investments. Is this for providing a retirement income? Is this for paying for my children's school fees at university? Exactly what are you trying to achieve? Maybe you're looking to buy a yacht in 10 years, who knows? You know, it's entirely you're focused around yourselves. Leads into probably diversification is very unique to all of us because our objectives are different. If we look at, for example, an income investor is unlikely to want to diversify into equities. However, they may wish to look at other asset classes like structured products, which provide enhanced income returns based on a group of criteria. Research is very, very key. I think, as the previous presenter stated, you should always make sure you know what you're buying. In some instances, it's difficult to know. If you're looking to buy a company perhaps in Latin America, you know, if you don't necessarily speak fluent Spanish or Portuguese, you might not necessarily understand their investment accounts, so it might not be suitable for you. So always bear that in mind when you're looking at your investments. Consider different asset classes. If you're an equity investor, why not consider investing in fixed income securities, structured products, cash-based deposits? Also think about, do I want to change and look at a bit of FX exposure? If you're entirely looking at sterling-based investments, consider yen, consider the dollar. It's all a good way of diversifying your portfolio. And the last point here is the world is shrinking. 10 years ago, I doubt if any of us would have perhaps considered investing in Mongolia, for example. One of the countries with the most natural resources available in terms of gold and silver, coal, massive natural resources, untapped. It's always something to consider. Don't just focus on main listed equities or other securities. Just consider different things. Next, I thought I'd just give you a quick example of how these are sterling adjusted. So, say for example, you're a sterling-based investor looking to take exposure into overseas markets. Now, I think the previous presenter stated that it's good to see how sterling impacts. It can be positive, can be negative. But if you don't take that exposure, it's impossible to know exactly where you're going to be. So these are 10-year returns. So over the last 10 years, had you invested in the FTSE, you would have looked to have achieved a 51% return. S&P has obviously been a standout, 96% return. And the emerging markets we can see down the bottom here are Brazil and South Africa. Although on a sterling adjusted basis have only delivered a 15% return, if you were a domestic investor in those particular countries, in particular in Brazil, for example, would have achieved 172% return. So if you were prepared to take exposure to the Brazilian currency and look to invest into Brazilian equities, you could have achieved, I'm sure you agree, as 172% is a big return on your investment. There are obviously concerns that we have to take in place. With Brazil, for example, we have liquidity risks. Are they as liquid as the UK markets, for example? Probably not. That's a concern that we need to bear in mind. However, it doesn't make them any less attractive to us as investors, but we should make that a concern that we should think about. South African market is highly liquid. As I'm sure the guys will tell you, it's run by the London Stock Exchange essentially. Good emerging market, good opportunities. Some slight political risk maybe, but generally pretty attractive to most investors. Although one thing I would say is that I'm sure if some of you do know much about the Johannesburg Exchange, a lot of the investments that are listed on that exchange are also on the FTSE in London. So you can also get exposure to those companies, but through the UK market rather than taking a direct investment in Johannesburg. The Nikkei over the last 10 years has been an interesting market to look at, and we as a firm are quite bullish about the Japanese market. It's coming in there, but never mind. Okay, from a domestic standpoint, if you're a Japanese investor investing in Japan, over the last 10 years you could have achieved a 39% return. Being a UK-based investor, investing in that market, 59%. Because the yen has been strong against most other currencies, we've been able to achieve, or UK investors in particular, would have exceeded those returns of domestic investors because of the fact that you've got that currency exposure and the fact that the yen has been generally pretty strong. And just to reiterate on the US market, over the last 10 years, this has been a standout market, really, especially in the last 3 years, really, since we had the financial crisis. If you look at the graphs about the US market, you'll see a steep climb from after 2008, 2009. Now, just moving on a little bit, just to give you some flavour on what we were talking about earlier on about direct investment. Now, direct investment, in this instance, we're talking about the Japanese markets. We're talking about fast retailing, which is one of the biggest clothing retailers, not just in Japan, but also in the world. This particular company, obviously, like most individual companies, suffers or can suffer from currency risk for us. Systematic risk, by what we mean here, is we're talking about government, market risks, things that are necessarily out of the control of the actual company itself. An unsystematic risk, some things that are specific to this particular company. Now, this year, this company, from a domestic standpoint, has produced a return of plus 3%. Okay? As a UK investor, because of the strength of the yen, it would have delivered an 11% negative return for you over that period. Which isn't to say this is a bad company in any way, but it has suffered, like some Japanese companies, from the sales tax that's been introduced by the Japanese government. Currency risks, where there's strong yen. And as a company on its own, because it's got some large exposure to Europe as well, and different markets within Europe, has also suffered from a little bit from those particular impacts from those markets. Now, if we were to take a broad market approach towards the Japanese index, in this instance we're talking about just, per se, the Vanguard ETF in Japan. Now, over the course of the last year, this particular investment has achieved a positive return for UK investors. As the fund, in particular, has a diversified range of investments within it across the small, medium and large cap equities within that particular market, it's been able to mitigate or diversify some of the risks that are associated with investing in Japan. It still will obviously still suffer a little bit from currency exposure, potentially, and other factors that are non-company specific. So sorry, lost my train of thought there. So from like the sales tax, for example, not really anything that the companies themselves or the constituents within that particular product can do about, but it's just associated with the market. But you can see it's generating a positive return for you. Now moving on to another concept. This is a particular concept that I'm quite passionate about. Now I think that this is something that was first introduced by Warren Buffett a number of years ago and was essentially commercialised by Morningstar. So just to throw it open to you, when you think of a moat, what do you think about? Think about castle. Yeah. But in financial terms, essentially, what we're referring to here is stability. We're talking about competitive advantage. We're talking about something that's going to make this company stand out in times of stress, in times of affluence. What is going to make that company stand out from the rest? And generally, the concept is split down into 5 different areas. The first one being brand. So if we think about that for a second, most handbags these days are mass produced in China. Same factory. One part we've got Burberry handbags. One part we've got Louis Vuitton handbags. Another part we've got Marks and Spencer's handbags. We might have a price tag of £500, £1,000, £50. As the man in the house, we're all sitting there thinking, have the Marks and Spencer's one, have the Marks and Spencer's one. Your missus is going to want the Burberry one or the Louis Vuitton one, isn't she? It's a brand thing, yeah? Same with Apple. You know, is an Apple phone any better than a Samsung phone? Debatable. Yeah, debatable. But if you got the chance, you're probably going to have the Apple one, aren't you? Market leaders. So here we're talking about somebody in a particular market that has got a big competitive advantage. So those of us that have been in the UK market for a while will probably remember QXL. Going to be the big competitor to eBay. How long did it last? A couple of years? eBay's still going strong, isn't it? Can you see? In the future, can we think of anything that's really going to compete against eBay? Debatable. Economies of scale. Nestle, one of the biggest companies in Europe, one of the biggest companies in the world if you look at their product base. You know, they don't just make chocolate, they make pet food, they make all sorts of other things. So they've got a competitive advantage in terms of the price that they can deliver to consumers that will help them achieve a long-term return. Opportunity costs. We're talking about investments like Microsoft here. So if we take an example of this, we're talking like business use mainly. So how many businesses around the world are run on Microsoft operating systems? Massive proportion. Yeah. Is somebody going to come in the near future, medium future, or even in the long future, or long-term future, that is going to step on their toes and say, right, we've got a product that's going to beat Microsoft? I don't know. I mean, Apple have tried for a few years with the OS system. It's useful in some respects for designers, but ultimately in business use, it's unlikely to change from Microsoft in the near future. And infrastructure. Now, the example I've given here is a Mexico-based, this is Carlos Slim's company essentially, Telnet, or Telefonos de Mexicos. Basically operates 80 to 90% of the telephone infrastructure in Mexico, one of the biggest and fastest developing markets in the world. But this could quite easily be a pipeline operator or a company that provides a specific infrastructure in a company, so something like the national grid in the UK. Now, over the last 10 years, now in this particular instance, we're using the dollar-based return here. As you can see, we started off slow, and then we had obviously the crash that came down, and then we've seen a gradual uplift over the course of the last 6 years. Now, believe it or not, when we consider most investments, we often consider medium cap and small cap investors to be the ones that are going to produce big returns. But here we're actually talking about large caps. So we're talking about the companies that we talked about before. We're talking about ones like consumer staples, things like J&J, Johnson & Johnson in the States, Unilever, ones that have got big diversified portfolios of services, products that can deliver those returns to you as investors over the longer term. And I think you probably see there, I've just put 232% rise over the last period. And you can see most of that's been backloaded into the last few years. And I think because of the fact that they're consumer staples in that index, that during the times when we've had issues like crises, investors often look to those particular companies for utilities, whatever else, that are just going to carry on, ticking. And then as the markets improve, people think, well, hold on a minute, they've done really well for us over that period, saved us, enhanced our wealth over that period. But look at the amount of products and services that these guys offer. Look how many different markets they're in. Often these guys have got exposure across the world. So they're not just perhaps US focused, they'll be South America focused, they'll be African focused. Something like in the UK, Diageo, for example. Now, one thing, just a little story, I think, that this doesn't have to necessarily be global focused. This could actually be national focused. So although we're talking investing around the world here, an interesting answer that came up from a colleague of mine who's actually in the room here, so he'll remember the story when he told me. But we look north of the border and we talk about Iron Brew, for example. Yeah, national moat, because how many companies, and those that your history in the UK, were sitting and saying, how many people have tried to produce a product that competes against Iron Brew? A number of them have tried, but how many of them have actually achieved it? Failed miserably. And it's a good for AGBR, the actual owner and maker of Iron Brew. They've made a fortune out of this over the years, but nobody can compete with them. And the most important thing is, as you can see from the trend line, it's looking like that it's going to carry on for the foreseeable future. Although nothing, as we all know in investing, is guaranteed, it's still showing a solid upward trend line. So in summary, I'd just like to say, to me, always the most important thing is to diversify your portfolio to the best of your abilities. To be open to new asset classes and to embrace new investment concepts. And for those of you who are UK-based investors, remember to take advantage of your tax-free allowances. ISAs, or NISAs as they now are, and SIPs mean that you can maximise the return on your investments without having to pay capital gains tax and income tax on those particular investments, as most of us know. And also, they offer good opportunities for things like the emerging markets across Europe and the UK to take advantage of low cap stocks and get into the growth area at a reasonable time and offer good potential long-term future.